We won't pay attention to the camera. It's just going to be
right?
you and me. Ready? Okay, here we go. Welcome, everyone. This is Will and the Reality in Real Estate Podcast. Today, I am joined by Mr. Michael Standard with Fairway Mortgage. How are we doing today, Michael?
Doing great. Hi, Will.
Are we having fun yet?
Not yet.
Not yet? We're about to, though, right?
Absolutely.
Why don't you tell us a little bit about yourself today?
You bet. I'm with Fairway Independent Mortgage. My NMLS number is 167-4259. And again, Fairway Independent Mortgage, NMLS number 167-4259. So we got the compliance out of the way.
Right? We got the hard stuff out of the way. Now we can get down to business.
Yeah. So I've started in the mortgage business because I have a passion for being face-to-face with people, especially seniors. We're going to talk a little bit about them today. But my history is I was 15 years as a stockbroker in the bank channel, then 15 years in the corporate world selling software to banks and broker-dealers and insurance companies. So I understand the financial market and what's happening. I really have a passion for helping people not outlive their money.
Right.
Big deal.
That's a huge deal.
Yeah. Been married 29 years to the same woman. It is a woman. And the other I've got 3 great kids. I love to hunt and fish.
Yes,
I don't
you do.
fish as much as you, but I do love to hunt. And I just have a passion for cooking and wine and food and just enjoying myself.
And see, when you hunt, you can use the passion for the wine, the cooking, and the food all together because you've gone out, and you and I have actually had the joyous time of going out and going duck hunting, which was a kick in the pants. And right before we started recording, you actually said that the hunt isn't going too well right now, but
birds
hopefully
are not in. Yeah.
the birds are out. But luckily today we are full of mortgage information, so
Absolutely.
rather than hunting talk, we will kind of get down to that. Well, let's start off with some easy stuff for everyone out there listening. What is the current state of mortgages right now, in your opinion?
You know, in my opinion, looking back over time, but we can't do that anymore.
No.
You know, we have to look forward. In 2008, the Obama issues we had with the economy, they put a lot of safeguards in. I think we have a lot of buyers out there who are thinking that they're going to get a good deal again, that they're going to get rates back down. No, those rates were artificially deflated and brought down. So we're in a situation where going forward between 5 and 6%, that's going to be a great rate.
Yeah.
In the next 12 months, we're probably going to see a quarter-point difference. Probably, matters which loan programs you go with, because there's a lot of different loan programs out there. Some where first-time home buyers can get their down payment paid for, right? And which makes your payment horrible. But in the big scheme of things, you're looking between 5.25% to 6%. It matters a lot of different things. A lot of different things go into that, as you're well aware. Yeah. Credit rating, your income, your debts,
down payment ability.
Yeah, right. So I see the market as this right now. If you were my son, I'd say this is the time to buy, because this quarter it's flat.
Yeah.
Less homes on the market, right? Rates are about as good as you're going to see them, and it's time to get out there and find a deal.
Are you finding that there are deals to be found in mortgages if you're out there looking for something like something exotic? Are those types of products out there? Are we, with the advent of all these regulations, did we see a lot of those things go away, like the crazy 80/20s and things like that got people in the mess in the first place back in the mid-2000s?
I think there's a lot of safeguards now. That's not going to happen. There are some different loan programs out there. I work with a lot of investors, and we've got investor loan programs. If a client has 3 homes or more, rental homes, that they'll allow them at a special rate to come in, and they'll finance them at 84%.
Really?
Yeah. Again, you have to meet those special criteria. So if you can meet all their special criteria, you can get a loan. You can go to the banks and get a loan if you meet their criteria. But why we use mortgage brokers and why you work with me and other mortgage brokers like myself is because we have lots of options.
Yeah.
At Fairway, we are the 4th biggest mortgage lender in the nation.
Wow.
And I have hundreds of underwriters in different time zones. So we can make sure that we can help the clients wherever they're at with whatever they need. Credit challenge people, it's tough. I love working with professionals. We've got some great loans out there for kids with lots of student loans.
Okay.
And that's
something that's huge right now because we have people coming out of college with I mean, they're getting a $15 an hour job, and they've got $200,000 worth of debt from University of Pennsylvania or wherever it may be. And that's a severe challenge. I mean, I have a doctor is saddled with $300,000 worth of debt, and he exactly had that type of problem that you're talking about. What kind of things can you do for those types of folks?
Well, there's a couple special programs I work with. They're Fannie Mae. Fannie Mae owns most of the college debt, right?
Yep.
So they will work with our clients to itemize or to alleviate some of that debt on paper. They still own the debt. Of course, the kid still has to pay it off.
Yeah, right.
But we can base it off of their income. And so they'll income grade it, so to speak. So if I'm usually paying $1,000 a month, maybe I can get it graded down to $150 a month.
Oh, wow. Now,
Therefore,
that's huge.
I can get a loan
because
now my debt to income ratios are there and where they need to be.
Well, those are, this kind of stuff is awesome. And Michael's going to be a guest of mine on a recurring basis. So we're not going to get into that stuff as much today, because today we want to focus on a unique product that you have and that is really exciting and interesting to me, and that is the home equity conversion mortgage. And what it does is it helps us kind of look towards the future and how we can help our aging parents. You want to tell us a little bit about that?
Yeah, that's a great. In the situation we're faced with today, and I'm going to go into some statistics, but this should be something that we as the sandwich generation, that's 50 to 60, with our parents who are older than us, we need to know these things because we have to help them.
Yeah.
We have to help them make a decision. 70% of our nation today is in a nursing care facility or using a nursing care product of some sort, in-home care or something. 70% of them. And that's what we're faced with today. It's going to get bigger. Much
bigger, because we have the baby boomers they're getting to that point where they're retiring, and even if they're working into their 70s, which is not that uncommon, this is something that is going to have a huge impact on their life.
It is. And number two is that 5% of those people, of the 100 really, so 5 people out of 100 have long-term care insurance.
That's scary. As somebody I'm 41 years old, as I look towards the future for my parents, what does that entail for them or for me?
Well, the irony is, coming from that industry, the insurance industry, most of the long-term care insurance providers are going out of business. They don't want to stay in business. It's too expensive because our medical costs, your wife's a nurse, right? It's very expensive.
Very.
Super expensive. So we're faced with our parents needing this information now. So you can make a decision today. If your parent's over 62, okay, and they own a home or want to purchase a home, we'll talk about the purchase program too. HUD made some major changes to the program. This used to be called a reverse mortgage, and I know that's a dirty word, right? Nobody likes to say that. But what they did was, in October of 2017, they said it's going to be a mandatory FHA insured loan.
So it's more like a regular loan that you and I deal with on a daily basis.
Correct, and the government insures it.
Okay.
So that means this. They pay a fee for that on the loan, and they pay a transaction fee up front. But the kids will never lose. Whoever inherits a home, if the loan's $300,000, the home can only be sold for $150,000. FHA insurance eats a loss. That doesn't go to the estate as a loss. That doesn't go to the probate courts as a loss. They don't have to file. It's eaten by the FHA insurance. So your parents don't have a risk of passing the property on to you because it won't be a loss.
And that's a huge deal when you're looking at estate planning and things of this nature, because if you don't have to worry about that debt on the books, if you have a family of 5 people, that's a lot more money for the family to have in the estate and to save for the future for things rather than debts.
Yep, they keep title to their home. It's the only loan that they keep title to their home. So if they own it now, they'll still own it in the future. The third thing is it has a spousal rider on it. So let's use the example of my parents. Let's say my dad gets remarried and he marries a 40-year-old. Well, since that's the spouse of my father, if he has the loan, she can live in the house until she passes away as well.
Really? Now, what's the payment scenario on something like that? If he passes away, how does that work for her? To simplify it.
She's married to him, so therefore she's on the loan as a non-borrowing spouse because she's too young. The magic age is 62.
Okay.
So if that happens, she cannot be kicked out of the home.
That's huge.
Right. It's ginormous.
Yeah. And that's a huge change from the way it used to be as well.
Exactly. And for same-sex marriages, if they're married, same rule applies.
Really?
Yep. So nobody has to leave the home. They can sell the home at any time with no penalty, right? Which is really good.
Yeah.
And we can talk about the purchase program too, but let's stick to the senior side of things. Because the seniors are faced with medical costs that are going up. The average medical cost for your parents is going to be $250,000.
And that's conservative, I would imagine,
to
some degree, depending on what they're going to be faced with down the road.
Well, because Medicare, remember Medicare, the insurance we get when we're 65?
Yeah,
that pays for some of it. Yeah, theoretically. That pays for some of our medical costs, but we're talking about the out-of-pocket costs over and above what Medicare or supplemental insurance will pay for. My dad had a triple bypass.
Okay.
He's still here. He's past 3 years from the surgery. His $120,000 of debt that he has from his bypass.
Are you kidding me?
No, because Medicare covered half of it, so it was a $250,000 surgery.
Wow.
Right? One time. You fall and break a hip, still about $200,000.
Yeah, I mean, because you have, regardless of the hospital stay, then you've got the surgery, then you've got the therapy, then you've got the long care nursing, and then you finally get to go home and you may need an in-care nurse. I mean, what you were talking about earlier, these costs can mount incredibly quickly.
Absolutely right. And so our parents are faced with that. So we have a couple decisions to help them with that we need them to make before it's too late. Okay. Before they fall and break their hip. One, get your power of attorney set up, right? Mom and dad, who's your power of attorney? That's important. You have a will set up, mom and dad? Yes. Okay, we do. Then we have to deal with this. Should you sell your house now and move in with me? And that's a real option.
That's a reality.
Yeah. Number two, can I afford to pay your long-term care insurance when something like this happens? Okay, probably not. But if I could buy a policy for them today, I would, right? But they're older and they're going to be really expensive. We're talking probably $5,000 to $10,000 a year.
Really, that's
for long-term care insurance.
And what is there a cutoff? Just to give us a little
65.
background. 65. After that, it's not available to someone.
Well, you can still try,
but more than likely, you're not going to be able to get it.
And I'm not an insurance agent; I can't give that information anymore. But generally, correct. The other thing we can do is we can pay for their nursing care, out of pocket, and that's about what, $8,000 to
$10,000 a month. Yep.
Yeah. So, and if we do all those things for them, then you're going to be talking to me in 20 years to help you with your reverse mortgage or your new home equity conversion mortgage, because you'll run out of assets.
Absolutely.
So what we have now is 70%, okay, of our clients, of our parents are going to use it, okay, because everybody gets old and we're living an awful long time.
Yeah, much. I mean, if you look at an actuarial table over the last 50 years, I bet you we've tacked 5, maybe 10 years on. I mean, I have no statistic to back that up, but I mean, medically speaking, we are living much longer than we used to.
And that's a concern for all of us, because I don't want, my goal, the big reason why I made this switch, and I am, not to toot my own horn, but the regional specialist, Oregon, Washington, California, for this program, for Fairway, is this. I can help people not outlive their money.
That's huge.
That is huge.
That's something that, we see a lot of people, we see commercials for wealth management, but a lot of people want to just be able to call somebody and have some wealth to manage, let alone be able to pay for their long-term care and things like that.
One other thing for your parents, if they have less than $500,000 in stocks, bonds, mutual funds, or assets, okay, excluding their home, if they have less than $500,000, then they're probably going to have a Medicaid attachment when they have a spill. When they fall and get hurt, what happens is when you're released, you have to talk to an attorney, but they will ask you to sign a Medicare attachment waiver, which will attach your home
to Medicare
and your assets. Yep, because the average stay in a Medicare facility, if you're going to any facility, not Medicare, those are the last resort facilities. But if you're going to a facility or in-home care, it's going to be about $200,000. So they assume you're going to blow through that pretty quickly.
Very.
And so they then leave you $2,000 in cash a month and a car and your home. And so this is where we need to help our parents plan now, because if they own their home and we can set up a home equity conversion mortgage. Now, it's not easy to do. It takes 3 steps, and they also have to pass counseling.
Okay.
So they're counseled. We do an application like a regular mortgage loan. Then they have to go through counseling, which takes about 45 minutes to an hour.
Okay.
They quiz them about the loan. They quiz them about their mental acuity, ask them those type of questions. Then we do the appraisal and get the real numbers. With the real numbers, we can work out a real scenario for them. But with that loan, let's just use an example of because I can do this quickly in my head, a $500,000 home.
Okay.
They would pay their mortgage fee to do this transaction. Let's say it's about $20,000 to $25,000. Okay. It's not free. It's normal cost, including the FHA insurance. They have that loan there now of $25,000. That is their debt. Okay. Then they have the equity, so they'll let them take about 40 to 50% out. It's based on age.
Okay.
So then they could have about $250,000 to $300,000 in assets that they could pull back out of the home.
In cash. If they want to go to the casino and light it on fire, they can. I mean,
Yes.
just to paint a realistic picture.
I hope our parents won't do that.
So do I, but
But they can also set it up as only a line of credit.
okay.
They don't have to take cash out. They can leave that in there as their long-term care policy, essentially. So they can take the cash out, and the cash comes out tax-free.
Oh, and they can take that out. They basically take a draw on that like they would a normal line of credit.
And then with these loans, they never have to make a payment.
Wow.
They're not
That's
required
huge.
to make a payment. Remember now, it's insured, so you and I won't lose if it goes upside down. Medicaid cannot attach the home because now it's an asset, right?
Yeah.
3, they can spend all the cash they need or have, and they still won't get kicked out of their home if they spend it all.
And it doesn't matter if they take this out at 62, let's say 62, let's say they live to their 92, 30 years, they're not going to have a house payment that entire time, and they've got $250K out of a $500,000 property, using the numbers that you had brought up, and they have nothing to worry about that entire time. They are on
Property taxes and insurance.
That's it. Just like if they had their home free and clear, but they have a huge chunk of change. And is that chunk of change earning interest?
Yeah.
It is.
So the loan is set at, let's say, let's use example 5%.
Okay.
That's what the loan's accruing. The line of credit's also accruing or gaining interest at 5%.
Oh,
And it
wow.
adjusts every year.
Okay. Up or down
Up
based
or
on the
down,
market?
Based on the LIBOR rate.
Okay.
If they're investors and they have a lot of assets, most of the investors go to a monthly adjustable rate.
Okay.
And now everyone says ARMs are bad. No, this is reverse. This is backwards. We want the higher interest rate on your line of credit, don't we?
Yeah, absolutely, because
I
you're
want
making money on that.
Exactly. So, and you don't have to pay the debt until you pass away.
And so then, just to give us a little background on how that works for a family member that may be dealing with this. Okay, so let's say we were 62 when we took it out, and 92, mom and dad passed away, unfortunately.
Right.
What does that look like for the kids? How do we deal with that?
So they have 12 months to sell the home.
Okay.
Okay. And there's 3 steps, and I want to go back to the scenario that we're faced with. Let me use a real life example. So this person gets this loan, and 15, 20 years later, 30 years later, they have a $400,000 debt.
Okay.
Okay. And the home, of course, is going to appreciate over time, but we don't know what that's going to be, right? So let's say now the house, that $500,000 home, is worth $850,000.
Okay.
So the kids would sell the home and they'd pay off the debt, just like any bank, right? But now this is owned by FHA. FHA is the government, which this turns into a Ginnie Mae bond, by the way.
Oh, okay.
So people invest in these, and people love them because it's an insured mortgage. So the kids get the remainder between $400 and $850. That's theirs.
Okay. So they're looking at, after costs, and let's say $50,000 in cost and $400,000 in debt, we're looking at $400,000 net.
Yeah.
On that.
$350, whatever.
Yeah, whatever the
You
number.
get the equity, but what if it was upside down?
Okay.
Then guess what? FHA insurance eats that loss.
No, nothing to worry about.
Nothing to worry about.
That's the huge kicker that I really want people to focus on,
Right.
is that because it is an insured product, they're not having to stare down that barrel of all of this debt that may have accrued on an old reverse mortgage or on any type of mortgage that they took out, whether it's a home equity line of credit or whatever it may be. This removes that concern for them.
Right. And then the next phase of life, remember we're talking about this transition for our parents, trying to help them understand this now, because it's not right for everybody. Okay. But we want the right ones to learn about this and to use it if they can. It's not a piggy bank. It's not a magic piggy bank, right? Yeah. It's something that we're just turning that asset, those 2x4s, into cash with no payments.
Exactly.
If they didn't do this, let's say use an example of a client of mine who couldn't get this done fast enough for them.
Okay.
She gets sick. She had a heart attack and a stroke in the same day. Not kidding.
That's the double whammy there.
That was no fun. And I'm trying to help the husband maintain the house because he is not well mentally.
Okay.
He has some issues. The power of attorney wants to do this for them. The power of attorney steps in and says, how fast can we get this done? She's coming out of the hospital in 2 weeks. So we're working on it. This is not a fast process, but we're about halfway through and she's out. She gets released and kicked out of 3 different places because she's difficult to deal with.
Okay.
Make a long story short, they then put her in hospice care in her home for $10,000 a month.
Wow.
Blew through her cash. We couldn't get this done fast enough, so Medicaid attached the home. So in her situation, it was a really bad scenario. But if we can get them before this happens, our parents need to know about this before. Get it now. Let the interest accrue, right?
Absolutely.
Use it because now Medicaid's getting that house.
Yeah, and
if there's extra debt over and above what the house is worth, Medicaid's going to take it from their checking account, their savings account, their other assets.
They're going to get their money one way or the other, regardless.
Right. Elder care attorneys are really important in this phase of life too. To have these people work with your parents on their will and talk about, okay, if this happens, how do we move the assets appropriately and correctly to avoid this? And the elder care attorneys I know are absolutely for this product and the use of this product when it's right.
In the right scenario.
Right.
And one of the things that I wanted to go back to real quick to touch on was the fact that they go through counseling. I really like the fact that they go through counseling because you remove that concern of somebody being taken advantage of.
Correct. And
because a lot of times we see that in a family situation where, there's a accusatory, statements made that, Johnny took advantage of and dad and now all the money's gone or whatever, but this removes that because they have signed off on it and the counselor is saying they are ready and able to take this mortgage out.
Right, they have to understand it. And the best part for me is I can't sell them a thing. They have to qualify for it. Mm-hmm. I cannot get them this loan. They have to pass counseling, okay? And they have to have their finances in order as well. Yeah. Because they can't just give this loan to people who are in really bad shape, because if you don't have the margin of income to take care of yourself over and above your taxes and insurance, mm-hmm. and have the specific margin, then we can't do it for you. So it's not right for everybody. But we want our parents to know about this.
Yeah, we absolutely. And go ahead. I'm sorry.
And you can do more research if you don't believe me at www.hud.gov.
Okay.
Right? And search HECM, HECM. And it will go through all these rules and regulations I've just stated.
So what I'll also do for our listeners is I'll put that information in the post for this show, right. So that I'll post the link in there and I'll put a direct link to HUD so that they can find this information.
Awesome.
One-stop shop so they don't have anything to worry about there. And you and I can talk after the show and include any other type of information that would be good for anyone that's interested in this type of information.
Yeah.
How can people find you on the internet, email? And I'm going to include all this, but just for our listeners, in case you're out in a car or something like that, how can we reach you by email?
Email is michael.standard at fairwaymc.com.
Okay, and phone number?
Phone number, that's the best way to reach me. Call me or text me at 360-690-5278. That's 360-690-5278.
Awesome. That is great information. Like I said, I'm going to include this in our post.
Yeah.
You'll have that information. I'll be giving you the recording and all of that kind of stuff. But I really appreciate you sitting down. Is there anything else as we wrap this up that you want to go over that we may have missed?
Something that's really important for us as the sandwich generation to understand. HUD made these major changes because they want our parents to age in place. Because if they can do in-home care when they have that issue, mm-hmm. it's far cheaper for them, far cheaper for the government, because then they won't go on to Medicaid. Medicaid is our Section 8 welfare, right? And that's the third largest national debt, is Medicaid.
Wow.
And Section 8, that whole process. We need to use that when necessary, but if you have equity in a home, and you own your home or almost own your home, it's really important. There's almost $7 trillion of equity in seniors' homes.
Wow. Let that sink in. 7 trillion. That's a T, everyone.
Yeah, that's huge. Because of the old way they did things, people don't know that there's a new way. They ignore this process. Please don't let your parents ignore this anymore. Have them talk to me. Have them talk to another professional in their area and really understand the product and how it would work for them. Because we want to keep them off of Medicaid because it's not good. It's not good for anybody. And what I also want to say is to your listeners, if you have clients or if you have parents who have an existing HECM mortgage, an old reverse mortgage, sometimes you can refinance them to the better one.
Really?
Not always, but sometimes.
That opportunity is awesome. So they can reach out to you, ask you those questions as well.
Right.
And that's, what I mentioned at the beginning is we're going to have a recurring guest appearance for you. So everyone that's listening, if you have questions for Michael that pop into your head, you can email me at will@kineticchaos.com. You can also you can find us on our website, like I said, kineticchaos.com, and you can call me or smoke signal, doesn't matter. You guys know how to get a hold of me, and I can get you a hold of Michael. And all of this stuff will be on the website. And just to wrap it up, this is an amazing product. I hope everyone finds this as intriguing as I do, that there's an opportunity that so many people don't understand is available to them, and that they are protected. This is not something that they're going to be preyed upon, not from you, but from anyone. These products are out there, and they're finally in place so that people are not going to have to use that dirty word or think that reverse mortgage is a dirty word any longer.
Correct. And for our next show, I want to throw out a little teaser. We can talk about how a senior can purchase a home, a new home, up to a fourplex, if it's FHA qualified, for 50 to 60% down, and never make a payment again.
That's huge. Well, that's a great place to leave everyone so that they're waiting with bated breath for our next show. We'll have you on. It'll probably be, I'm looking at every 3 to 4 weeks we'll have you on, and give people a chance to get questions in. You can find us on Facebook as well. All of that. Michael, thank you very much. Do you want to give you any more information out your NW or your? Nope. Okay, we got all the. I just want to make sure the compliance stuff is taken care of because I know just how important that is. So, thank you very much. Have a wonderful day, everyone. Thank you for listening, and we will see you soon. Awesome. Take that real quick. Thank you.